Good afternoon. How's everyone doing? It's hard to believe we are at the end of August. Happy August 27th, Friday. This is the last Friday of the month. It's crazy. It's really crazy. Hey, welcome. My name is Craig Modelmog. This is Wall Street X's and O's for those of you who join me, or at least haven't joined me once. I didn't want to be arrogant and think you join me regularly, everyone that is. For those of you that are joining me for the first time, this is uncut and unedited. It's one shot. Here we go. It's really designed to be informative, really educate you about what's going on, the things that you aren't hearing in the news, with the whole goal of trying to paint the picture a little clearer and help us become better investors. At the end of the day, that is my whole goal, personally as well as professionally, serving all of you all, that being my clients and people watching this. So without further ado, we're going to kick this off with my disclaimer. None of the information on this show constitutes an offer to buy or sell anything. It is also not a solicitation to buy or sell any security or investment vehicle of any kind. It's not an investment recommendation. It is not legal recommendation. It is not a tax recommendation. It's just not, because it can't be. This is non-tailored for any specific person. And the information that is on this show is believed to be accurate. I will tell you it is, but from a disclosure standpoint, it's believed to be inaccurate, and I'm not responsible if anything was reported incorrectly or the numbers are wrong. Don't you love how disclaimers read? It's basically, I'm not responsible for anything, although I take full responsibility for my actions and how I talk to people. But all the content on this show is for informational purposes only. So anyway, without continuing to bore you, we're going to kick this thing off. I've got a really good show today. I really feel like I do every other week. I do this because I really try to focus on good information so it's worth your time. I want it to be worth your time. I'm going to talk about quantitative easing versus this double barrel approach that our government has latched onto. You will also know, for you first timers, I'm very political party agnostic. I don't claim either one of them at the moment. So this is not politically motivated. So do not take it as such. If you take it as such, that's your problem. That means your skin's a little thin and you need to get a little bit tougher. Okay. I'm just being honest. I'm really focusing on the facts and the truth. We're going to talk about how inflation is more than sticky. I've been talking about the stickiness of it. I'm going to elaborate on that more. And I've got some exceptional fun facts, just fun facts. Topic number one, quantitative easing versus this double barrel approach. What's the difference? If you go back to the financial crisis, during the great financial crisis, the quantitative easing that was executed was in the form of creating liquidity and putting liquidity into the marketplace, whether it be a government buying bonds, which they are still doing at $120 billion clip per month. If it was all sorts of different programs with an idea of trying to enhance liquidity. All that does is puts more money in the pockets of the rich, okay? Switch gears. As we got to this global pandemic, QE was not working, okay? We had a bond market little blurb right pre-pandemic and during pandemic where I think Fed Chairman Powell really kind of pooped his pants and really got proactive, okay? And then you saw a government really pick up the mantra of this, or pick up the ball and push it forward in a way that we have not seen our government do, which is they then transitioned from a single barrel approach, which was quantitative easing, into the double barrel approach, which is quantitative easing and putting money directly in the pockets of the American people. And we've seen that. We've seen that in the form of child tax credits, or just straight child credits. We've seen that in the form of mortgage forbearance, where you didn't have to pay your mortgage, you didn't have to pay your rent, you didn't have to pay your car payment. We saw all sorts of things where they just dropped cash in your pockets. Okay. Unemployment. They had pandemic unemployment assistance, which was an enhancement of the current unemployment, which to be quite candid with you, there was a good chunk of the unemployed population that was making more being unemployed than they were employed. No, that is not a Republican made up commentary. That is not a Democratic. I'm trying to throw stuff on that to try to get you to disbelieve that. It is actually just a fact. People were making more. Have you ever driven around and seen more help wanted signs ever? Ever. I have not. There's restaurants right now. Here's an example. My wife and I were in Kansas a couple weeks ago, moving our daughter from her house in her current living situation into her new living situation at the University of Kansas. On our way back, we stopped in Colby, Kansas. Those of you that know where Colby, Kansas is, one, you've either been on I-70 and you know that it is the only Starbucks between Denver and Salina, Kansas. They also call it the Oasis. Two, you're lost and you got there and you didn't know how. Well, here's what's interesting. We stopped at Jimmy John's right off the interstate, walked our two wiener dogs, got us a Jimmy John's. The lobby at Jimmy John's and at Taco John's right next door was closed because they couldn't staff it with enough people to keep the doors open. That's Colby, stinking Kansas, okay? So this is a real deal, all right? It's a real deal. So what we've seen is we've seen unemployment improve, but we've seen it where people have become unnaturally unemployed for an extended period of time. And the scary part on that is we've seen a huge number of jobs just vanish, okay? I'm going to jump ahead to a fun fact and I'm going to come back. Right now, pre-pandemic, there are 5.7 million fewer jobs today than there were in the economy pre-pandemic. See, I just jumped ahead of myself and gave away one of my fun facts. But in the midst of that, that's where you're seeing this massive explosion, and I call it the double barrel approach of a government panicking due to a global pandemic that they really didn't see coming. I'm not sure anybody did because nobody handled it well. Okay, there have been pockets where you could argue they did better than other places, but it's been a challenge, okay? And thus our government has reacted. Man, they've reacted up here, okay? Of which I could go down lots of in different avenues from there about the debt ceiling, about what the government balance sheet looks like, all these things. But anyway, it's comparing, contrasting financial crisis, which was literally on the verge of a financial meltdown globally, to a global pandemic and how differently the support has been, okay? It's going to be interesting to see how this continues to pan out. Stay tuned for coming weeks because I am going to be drilling down more and more into really some of the ripple effects of this. Let's move on to inflation. This is really what's going to be interesting. When you look at CPI, which is the Consumer Price Index, or inflation as we all know it, they kick it out monthly. It's something that you track and you watch. Here's what's interesting, and I mentioned this the last time. I mentioned it in a couple of my write-ups. When you look at CPI, a third of CPI is shelter. What is shelter? It's home prices. It's rent prices. Okay, what have those been doing? Okay, well, this is my example. Actually, it should look like this, going up. I'm not even sure what this looks like on the screen. It's doing one of these. It's going up. Okay, it's trending very high. As we all know here in Colorado, literally anywhere around the country, and prices are going up, both from a home standpoint, purchase standpoint, as well as from a rent standpoint. Here's what is interesting. When you look at CPI, mentioning that a third of it is shelter, okay? Right now, a third of household income goes towards shelter. Right now, that is one of the fastest inflating areas of the economy. Okay, here is the kicker. There is a 5-quarter lag on when those acceleration numbers hit the CPI number. Inside, I'm thinking holy expletive, because we've already seen inflation rise significantly in multiple areas of the economy. What we've yet to see reported is how the increase in home prices and rent prices, in which they're still going up and they're going to continue to still go up, are going to impact that inflation number. So when you see Powell, you see our government, you see Biden, you see all these people getting up in there and they're preaching and they're spinning the same narrative that this is transitory or temporary, it's garbage, okay? This is going to be sticky. And I'm anxious to see how the Fed handles it, because in my opinion, their hands are tied. It doesn't matter what they do, it's going to be wrong. They've let this thing ramp up out of control. And it's going to be interesting to see how they handle it. Stagflation is going to be a word we're going to get very comfortable with. And I think that's what we're going to see happen officially in Q3. And after that, it's going to be interesting to see how things are handled. What stagflation is you have growth that is rolling over and decelerating, which is what's happening. Growth peaked last quarter, Q2. And we're seeing inflation continue to maintain its elevated levels and in many cases rise. It's going to be fun to watch that, okay? Stay tuned, because that is going to be a big part of how we transition our portfolios. I've actually been transitioning it for a quarter, which if you look at a lot of, from a performance standpoint, we've been kind of flatlined. People say, geez, Craig, well, what the heck's going on? We haven't done anything. Well, it's because we're in a transitionary period, and when you go from one type of economic environment to a new one, it takes you time. You have to transition the portfolio, and it takes time. You have to be patient. You have to know that you're aiming at a different type of portfolio due to the data that's being reported and then what you're projecting from a probability standpoint, and it takes time to transition. So be patient, hang in there, okay? It's going to be so worth it in the end, because when you think of the type of environment we are heading into from a historical standpoint, okay, historical context, the best asset classes to own in a stagflationary environment are commodities. We own them. Gold, I started dipping my toe in again. Fixed income, which is mainly treasuries and high quality corporate, although that's even questionable. Okay, you look at sectors, utilities, tech, energy, industrials. Those are the types of things you want to own. It's basically to categorize them high quality. Okay, we vacated small caps here about 6 to 8 weeks ago. All right. Of which small caps went way up. They started coming off. We kind of stopped the bleeding and transitioned to quality. So you make that transition. That's what we've done. It takes time. Okay. The one area on the bond side that I'm very focused on is high yield, because credit tends to underperform in a stagflationary environment. And that's what we're entering. I'm watching high yield over treasury rates because they track the spread. Right now, the spread's pretty tight, but we're starting to see some movement there, in which if that would happen, I would eliminate all high yield exposure and it'd be all high quality corporate. And then eventually it's going to be treasuries coming into play. But for right now, it's really focused on high quality corporate one, and then looking at some tip exposure, maybe. Then, and on the high yield piece, that's going to be a part we're going to be kind of reducing exposure. Okay. Moving on. Last part here, fun facts. I got some really cool stuff here. This is good. Car sales. This is fascinating. Have you driven by any of the dealerships in town here? When we were in Lawrence moving Lausanne, I'm driving by the dealerships and no cars. I mean, this one Ford dealership, which trucks in Kansas kind of are synonymous, literally a dozen trucks, and that was about it. There's chip shortages, which has impacted the production of cars. We've seen cars decline by 500,000 units. That's 500,000 cars per month this is the 4th month in a row. That's a big one. That's actually a really, really big one. If you look at mortgage forbearance and rent forbearance, those have been put back in place in many cases. What do those do? They inflate prices. Why? Fun fact, if you own an apartment complex and you haven't received any rent from all your tenants for a while, and there is any type of tenant overchange or exchange, which is what happens this time of the year. I've got a good friend of mine who's a property manager, and he's like running around like a chicken with his head cut off because you got school starting, people are getting moved before the school year. Here's what's crazy is all of a sudden you see rents start increasing. Colorado or Denver, Colorado, on average, rents have gone up already double digits, north of 10%. And you're seeing that ripple effect nationally. Fun fact, right? Jobless claims went up, ticked slightly up. Last week was 349,000. Jobless claims this week was 353. Here's the good part. We have seen continuous claims drop now down to 2.86 million, which is huge considering at one time it was over 20 million people on continuous unemployment claims. To close it out here, if you look at oil last week was up 10%. It got killed the week before, so that's kind of why. But here's what's fascinating. Gas prices are elevating. We had one of the larger crude oil drawdowns. Okay, we have inventories of oil. Okay, we have this emergency kind of containment of oil, which we always have as a country. All right. Well, as we draw down on oil, you've got production that's down right now, and you have inventories that are being sucked down. So you've got this kind of dichotomy going on where you have usage of oil increasing and it's sucking down on inventories. Year over year, inventories are down 15%, which is getting to the bottom of a 5-year range. So when you've got President Biden getting out there into the public and telling OPEC that they need to raise production in order to cut oil prices, you don't get it. It's not just about production. We have low inventories. So we've got two things. We have production that's lower and we have inventories that are lower because usage is increasing globally. That's an interesting dichotomy. Are oil prices going to go down? Most likely not. Is oil prices a good leading indicator on inflation? Yes. Continue to watch oil prices, because as oil goes, in many cases, so go lots of other things. Okay. We're going to go to COVID. I know people go, oh, geez, Craig, you're talking about COVID again. Well, it's COVID's impact. With this Delta variant ramping up, are we starting to see any major negative impacts? Slightly. Okay. What we are seeing is you've seen retail sales drop a little bit. You've seen travel drop a little bit. And I think as we go into the fall, business travel's gone. I've got really good friends that used to travel for a living for their job that aren't traveling. So I'm anxious to see as we move into the fall, and depending on what happens to the Delta variant, and does it continue to expand? Have we kind of peaked and we're going to start seeing a decline? It's going to be interesting to see. But then it's not so much trying to argue about anything about COVID. It's more what's the economic impact, because whatever that impact is, I want to be on the front side of that and be prepared for that. And that's why I talk about it so much. It's not trying to argue COVID or Delta or vaccines or any of that garbage. That's what everyone's hung up on. That's what's created such a massive dividing line in our country and within families and within friends and whatnot. It's really, really sad that, you know what, let's get back to respecting others. I'll hop on my soapbox for a second, but for me personally, it's more, what is the economic impact and how do I need to position client portfolios to take advantage of it? Because there's always opportunity that's out there regardless of what's happening. So, great fun facts. I'm loving it. I'm trying to make sure I didn't miss anything. See, I'm looking at my little cheat sheets here. I think we're pretty good. Oh, last one. This is a good one. Lots of people own the QQQ index. It's the NASDAQ 100. It's basically owning Apple and Amazon and Google and Facebook. It's the Fan Mag, Microsoft is in there as well. Here's a fun fact. September historically is the worst performing month for the NASDAQ QQQs, the Qs as they like to call it. Okay. Right now, this is the 120th day that the QQQ index has not had a 10% correction. Going back to 1979, The median, which is the middle, is 75 days. Okay. The average, see, we're getting into some stats here. I'm testing your stats ability, is 134 days. That's the average. So that means you've got things way on the high end and things on the low end, but you've also got September being the worst month. What does that mean? You should do nothing. Okay, it's just a fun fact, right? But it's good to think about going, we did see volatility tick up today. The VIX closed today at 18.84. It was up $2 or 12.2%. Today was a good volatility day, and we saw markets kind of exhale. I'm anxious to see if this leads into September and what are we getting as we transition into the last month of the third quarter. Because like I said, right now the data is really showing a probability of a stagflationary environment taking place in Q3, and that's kind of what I'm thinking. Second in place would be more of a declining growth and declining inflation. I don't think that's going to happen. I'm going to stick with the statistics, and probability says stagflation. So with that said, this is Wall Street X's and O's for Friday, August 27th. This is Craig Model Mog. Thanks for joining me, and I am